Ch5-14A, we're going to look at doing adjustments and completing a worksheet that has a net income. So in your textbooks for 5-14A, you can kind of follow along. We have the trial balance. We also have the trial balance right here. Let me scroll up. We have our account titles and our trial balance, which is our first set of columns. And then it gives us A, B, C, and D, the adjustments that have occurred. So remember that adjustments are always made for the amounts that have been used, or have expired. Okay. So what we're going to do in the adjustments column here, which is already done for you, but we're going to show you and explain why, we're going to post the correct debit or credit for the amount of the adjustment. So A says that supplies inventory as of September 30th was $90. So we're dealing with supplies, and when we do our adjustments for supplies at this level, all of our debits are going to be expenses. You notice these are all to expense accounts, and then our credits are going to be to the asset account. So we used some supplies. Now you'll notice that it says we used $90 worth of supplies. So if we find our supplies account and we scroll over, we're not putting $90 in here because 90 is the amount that is left, not the amount that is used. So we have our $90 that goes into our adjusted trial balance. And so then we take our original amount, $635, minus the 90, and the $545 is the amount that's used. So we debit supplies expense for the portion used and credit supplies. B says that insurance expired, and in parentheses it says used is $650. So it is actually telling us the amount used. So we're dealing with insurance. We're going to debit insurance expense and credit our prepaid insurance because that's how much we've used. C says we have depreciation on delivery equipment. That's the actual amount that has been used or that has depreciated. So we debit depreciation expense and we credit our contra asset account accumulated depreciation. You'll notice nothing is done to the delivery equipment account. We always use the contra asset when dealing with depreciation. Then we have wages earned by employees but not paid as of September 30th. So that means we have some wages that belong to this accounting cycle, which is the whole reason we do adjustments. So they're payable. So we're going to have wages payable, but we're going to go ahead and expense them now so they account for September 30th, even though we're not going to pay them till later. So we debit wages expense and credit wages payable. Then you can see next thing we're going to do is we're going to do cross calculations. Now we're going to figure our balance after we make an adjustment. So that's our adjusted trial balance. So you'll notice that the only accounts that had adjustments have changes in their balances. Cash is still $1,600, accounts receivable is still $900, and so now you have to decide whether you're going to add or subtract, and this is where it becomes important in remembering how accounts increases and how accounts decrease. So supplies is an asset, so it has a normal debit balance, so I'm going to subtract the credit to get my ending debit balance. The debit is larger, so the balance goes on the debit side, plus it should always have a debit balance because it's an asset. That's its normal balance. I had $1,200 in prepaid insurance. I used $650, so now I have $550 left. Debit minus a credit is going to be a debit. Then with our accumulated, there was nothing in our accumulated, so it's like having 0 plus a $600 credit, which gives us a new balance of $600. Same with accounts payable. We had nothing in there, or we had $1,220, sorry, no adjustment, so we have our credit, our new same balance. Wages payable, nothing, so 0 plus $350 credit gives us a $350 balance. Okay, so then we go down to our expenses. Expenses have a debit balance, and so debit, it's like dealing with negatives. Like signs you add, opposite signs you subtract. So debit and a debit I'm going to add. These two here, it was 0 plus the adjustment, which gives us the new balance. So then what happens is we add all of our columns together. Okay, you don't have to put in a formula, you can just use a calculator. And then we're going to take, and now we're just dealing with our last three sets, our adjusted trial balance, our income statement, and our balance sheet. And it's just taking a snapshot. Like, so this, if I could just cut and copy this and paste it right here, it's the same thing. And if I could cut and copy this and paste it here, it's also the same thing. It's just which accounts go on the income statement and which go on the balance sheet. Then we add again, and we're going to have a difference here, and the difference is our net income.